Welcome back. Today we are breaking down one of the hottest names in AI infrastructure right now, Marvell Technology, ticker MRVL. This stock has nearly tripled from its 52-week low, and it just hit a fresh all-time high near $197. With the year-to-date gain sitting at a staggering 130%, the question on everyone's mind is there still room to run? Let's get into the data. First, the massive catalysts. Back in March, Nvidia announced a game-changing $2 billion strategic investment in Marvell, partnering through their NVLink Fusion platform. This directly integrates Marvell's custom XPUs into Nvidia's AI factory ecosystem. Then in April, Marvell acquired Polariton Technologies to push its optical performance past the 3.2 terabit threshold, cementing its lead in next-generation silicon photonics. And the ultimate near-term test is this Wednesday, May 27th, when Marvell reports its Q1 fiscal 2027 earnings. Wall Street expects revenue of $2.4 billion, up 27% year-over-year, with an adjusted EPS of 79 cents. Now let's look at the numbers. Marvell's trailing PV sits around 58 times, and its forward PV is near 47. Yes, that is a premium multiple. But here is the kicker. The PEG ratio is just 0.14. This tells us that when you account for Marvell's explosive growth rate, the stock actually looks heavily undervalued. With an RSI of 69, we are right on the edge of overbought territory, so some short-term consolidation wouldn't surprise anyone. However, major institutions are rapidly revising their price targets upward. Citi just raised its target to $215, Stifel went to $210, and Oppenheimer is at $200. Why all the bullishness? Two words: AWS Trainium. Marvell co-designed Amazon's Trainium 2 chip, and Amazon exited Q1 with a massive $225 billion in Trainium-related commitments. On top of that, Marvell has exposure to Microsoft's Maia chip, which is expected to contribute over $700 million by fiscal 2028. Driven by these massive custom silicon partnerships and an optical business that copper simply cannot compete with, Marvell's data center segment is projected to grow 40% year-over-year. The fair value study take? Marvell is no longer just a networking chip company. It is an AI silicon powerhouse. While execution must remain perfect to justify this premium multiple, the PEG of 0.14 suggests the market is still underestimating the long-term growth runway. Watch Wednesday's earnings print closely. If Marvell beats and raises guidance, $215 is the next stop. If we see a post-earnings dip back toward the $170 to $175 zone, that could offer a highly compelling entry point for long-term investors. That is the breakdown for Marvell Technology. If you enjoyed this deep dive, make sure to like and subscribe to Fair Value Study. Stay sharp, and I will see you in the next one. Thanks for watching. Disclaimer: this video is for educational and informational purposes only, not a financial advice.